the biggest issue which new traders have in the beginning is consistently losing. So if you take a look at this track record here, you can see how the losses were always smaller and the wins were always bigger. It's because, you know, there's a way how you can really reduce your loss as you know it's going to be a loss. So if you got 5 minutes, I'll show you exact strategy that I use to make sure my losses are always smaller. So let's say we have a support and you're looking for price to continue to move up and you're looking at a 30-minute time frame. So what we will do is we will break down the 30-minute into the 15-minute time frame. Let's say you're looking at the 30-minute time frame and you had a bearish candle that came down followed by a bullish candle which closed like a nice healthy body candle. So now when you're looking at this nice healthy body 30-minute candle, you're saying, okay, like, you know what, there's a very high probability for the next candle to continue to push up. So obviously when you do have a buy position, you're anticipating the next candle to continue pushing up as long as this candle respects the low of the previous candle, which means as long as this candle does not break the low of the previous candle, then your probability for price to continue to push up, it increases and your stop loss goes below the previous candle, because you know that if this low is broken by the new candle, then your buy opportunity is no longer valid. Now, let's take a look at the 15-minute time frame and let's take a look at how this 30-minute candle creates the overall structure on the 15-minute time frame. Now, if we're taking a look at this 30-minute on the 15-minute may look like something like this. We have a bullish candle here and then we have another bullish candle right over here. So these two 15-minute candles may create the overall 30-minute candle at this point. Now, when I'm taking a buy position and I'm saying that, okay, this new 30-minute candle should continue to push up, creating a lower wick, I'm also saying that on the 15-minute time frame, the new 15-minute candle which will form should not break the low of the previous 15-minute candle and continue to push up in a perfect world. Because for price to move up, we have to make higher highs and higher lows. So if we only talk about these 15-minute candles, we can see we have a higher high and we have a higher high right over here and a higher low. Now, if we're saying that, okay, what to do if price does continue to push down, right? So in that instance, what I'm going to do is if I have a buy position open right over here, let's say I have a buy position open with total risk of 2% and my stop loss, like the same buy, is right over here as well, and my stop loss is below the 30-minute candle. So in this case, on the 15-minute, my stop loss will be below the 15-minute candles right over here. Now, if I have a buy position open and the next candle pushes down, and as soon as it breaks the low of the previous 15-minute candle, I'm closing 50%. So 50%, I close, right? So if I have a 2% risk running and I close 50% right here, let's say I close 50%. Now, if price does hit my stop loss, instead of losing 2%, I'm maybe losing 1.5% or 1.25% because I'm looking at the smaller time frames and I'm seeing that, okay, if this 15-minute candle is breaking the low of the previous 15-minute candle, which negates the whole uptrend, higher highs and higher lows, market structure, then I know that, okay, if it's going to break the low right over here, then there's a high probability that the next 15-minute candle can continue to push down. Does that make sense? So my whole plan is this, that okay, if I'm taking a trade on the 30-minute time frame, and if I'm looking at market structure on the 15-minute to decide whether I should close 50% or I should close 40% or 60%, but in essence, I'm closing some percentage, taking some risk off of a trade, which now can have a higher probability to go in a loss, why not do that? Right? Why not take certain percentage off the table? Because if I want my trading history to look like this, where my losses are smaller and my wins are bigger, I have to make sure that I'm looking at the candle structure and deciding that now I'm going to close 50%, because let's face it, right? Let's face it. Whenever price goes to a stop loss and it's inching towards a stop loss, 90% of the time we know it's going to hit our stop loss, right? 90% of the time we know it's going to hit our stop loss. And this, if you follow this strategy, this works the same way if you're trying to take a sell because you're trying to see. So for example, let's say you're trying to take a sell, right? Okay, let's move this up over here. Let's say you're trying to take a sell. This is a bearish candle, right? And you're taking a sell right over here, and you're anticipating the next candle to continue to push down. Right now, for this candle to push down, you want this candle to respect the high of the previous candle, which is where you have your stop loss, right? But instead, what happens is that if, let's say, the next candle starts to break the high of the previous candle, this is where you're closing 50% again. It's simple, because you're not letting the whole candle go to your stop loss. You're looking at the smaller time frames, and then you're deciding that, okay, these lower lows and lower highs, or higher highs and higher lows, are not being respected on the 15-minute time frame. If I execute it on the 30-minute, then I should be closing 50%, because now if price is going to hit my stop loss, I'm going to lose less than expected. So I'm just going to quickly show you some examples and results from our students who have been following our strategy. You can see that the executions are there, the stop losses are there, the whole price action, the whole information and the reasoning behind taking a trade is all there. Because let's face it, most of the times when we are going to take a trade, we're just going to take a trade, and just because we felt like price is going to go up, we felt like prices are going to go down. So enrolling in Market Fluidity University is going to be a life-changing decision that you're going to make, because we have Zoom sessions, we have live calls, Q&As, we have simulation sessions, and man, trust me, trading starts from lowering your risk first. So this whole video that I did, I know it's been more than 5 minutes now, but this whole video that we did, watch this again, and you will learn how to manage your risk and make your losses even smaller. And then obviously once you do enroll in, it's going to be a whole lot more open knowledge and value that we're going to show to you in a Market Fluidity University. So hopefully we'll see you there.